Yes, after a break in 2020 from required minimum distributions, they are back for 2021. Now, this is mostly just a headache for most retirees, something they don't want to have to deal with. But in today's video, we are going to give you some good news that 2022 will bring to RMDs, as well as a tax tip that can help you use your required minimum distributions to your advantage. So first of all, what are required minimum distributions and what is the purpose?
Amber, the purpose is that the IRS wants to tax your money. So required minimum distribution applies to all of a viewer's tax deferred accounts. IRAs, 401ks, TSPs, 403bs, 457, anything that's been growing tax deferred for decades. The IRS has said, the fun's over, start paying up. So they calculate the minimum amount you must take each year once you turn 72, just so they can tax it. Doesn't matter if you want it, doesn't matter if you need it, they just want to tax it.
So this is important to note that it is just a minimum. You can take more than that if you need to.
Correct.
But a lot of people just look at those minimum distributions as a headache because it increases their overall taxable income.
It's important to note that required minimum distributions are based on the total of all of your tax deferred accounts, okay? Doesn't matter if you've got some in an IRA, some still in a 401k, maybe you work for the government, have some still in a TSP. We take the total of all of those amounts, we add them together. We look at the value on December 31st of the prior year. So let's give our viewers an example. Amber, let's say that one of our clients has $500,000 in his combined tax deferred accounts, okay? To determine how much he must take out to meet the IRS minimum distribution requirement, we look at this table. Now, I want to point out what this table is, Amber. You'll see in the blue it says current uniform lifetime tables. I have to timestamp this video. That is for 2021 tax year, okay? So someone turning 72 in 2021 must take out 3.91% of their total tax deferred accounts to meet the required minimum distribution. So in our example, $500,000 would be $19,531 would have to come out to meet the IRS distribution. With me so far?
Yes.
Okay. Now look at the green table. Here's the good news that Amber alluded to. In 2022, the tax tables are changing, meaning the IRS is actually adjusting it for life expectancy, for longer life expectancies, and people will take out less money each year from their accounts for their required minimum distribution. Let's go back and take a look at that table. Same example, say our client's turning 72 in 2022 now instead of 2021. Rather than take out 3.91% from their account, he needs to take out 3.65% in 2022. So instead of having $19,531 coming out, he'd have to take out $18,248. Now that's going to change for everyone starting in 2022. So that's the good news, Amber. If we keep looking at the table in the gray, it shows that the RMD is actually decreasing by over 6% per year. So for people who don't want their RMDs, don't need it, don't want the headache of the tax bill, that's a reduction starting in 2022. That's the good news.
Okay, so as a quick side note, we are talking about traditional IRAs and retirement plans.
Correct.
If you have already converted to a Roth IRA, these RMDs do not apply to you.
That's exactly right. Or Roth 401k too.
Right. So Corey, tell us how this affects people who have maybe inherited IRAs. I know there was a rule change back in 2020 about this.
Right. So in 2020, the IRS changed the rules with required minimum distributions on IRAs. And here's how it worked. If a death occurred prior to January 1st of 2020, the beneficiary needs to look at this table to determine how much they have to take out for the required minimum every year for the rest of their life. Now again, like Amber mentioned, that's just the minimum. They can take out more. If the IRA owner's death occurred after January 1st of 2020, then we don't use these tables. Instead, there's a new 10-year rule which states that the beneficiary must deplete the account by the 10th year following the date of death. Now that does apply to all retirement accounts, including Roth IRAs, Roth 401k. So even though it's not taxable, it all has to come out by the 10th year following the date of death.
Good to know. So at the beginning of this video, I promised you a tax tip. Let's talk about that.
Now, Amber, again, people don't want to have the tax headache from these RMDs. A lot of people don't want it. They don't need it. So here's a tax tip for retirees. Many retirees are paying quarterly estimated payments to the IRS to meet their tax bill for the year. So they look at their taxes, what they owe last year, they divide it by 4, they send it in every quarter to the IRS. Problem with that: 1, it's a pain in the butt. 2, what if someone forgets? 3, what if they're late? The IRS will actually penalize you for underpayment based on when you made those quarterly tax payments. So if you made a quarterly tax payment late, if you skipped one and only made 3 last year, then guess what? There's a penalty for that. So here's the tax tip. Use your required minimum distribution to pay your tax bill in full. Here's what I mean. The IRS considers taxes withheld from an RMD by your IRA custodian to be made to cover the whole year. There's no timing issues. So let's say that a person owes $10,000 in taxes for the year. Normally, if they're paying quarterly tax payments, they send in $2,500 every quarter on time to avoid penalties. Using your RMD can actually pay your entire tax bill in December. Here's how you do it. You call up, in our example, gentleman needs $19,000 from his IRA to meet the required distributions. He has $10,000 sent in to the federal government for his IRS bill. Guess what? He's covered his whole tax bill for the year. He did it in December, making no payments. The IRS says that's fine, that's on time, that's legal.
So this does a couple of things. Number 1, it helps you to keep that money in your account a little bit longer.
Much longer, yep.
And number 2, it takes away a lot of the headache of making those quarterly payments.
Exactly. So two benefits by using your required distribution to pay your tax bill. But I do want to offer one other tax tip with these required minimum distributions. If you are over 72 and you need to take the money out and you don't need it, don't want it, you can give it to charity. You can make what's called a QCD, or qualified charitable distribution, where your custodian sends the money directly to the charity of your choice and you never get the money. Here's what that does. Number 1, it satisfies the RMD amount. Okay, they'll calculate that $19,500 for our client. They'll send it to the charity of his choice. For the client, it doesn't show as income on his tax return. So it keeps his adjusted gross income down. Now, why is it important? Because we use adjusted gross income to determine taxes on everything else. We use adjusted gross income to determine what percentage of your Social Security benefits are taxable. We also use adjusted gross income to determine how much you'll pay in Medicare premiums. IRMA, right? That monthly adjustment for Medicare goes up if you make too much money. So by doing the qualified charitable distribution directly from your IRA to the charity, you keep your adjusted gross income levels down and hopefully reduce taxes in other areas of your life.
So today we've talked about some good news for required minimum distributions, but they can still be really confusing and troublesome. So if you need some help with those, you can go to workwithnewgen.com to schedule a 15-minute introductory phone call.
Because you can make the rest of your life the best of your life.
Plan now to retire happy.